Alright, welcome back to the CFA Level 1 program curriculum. Reading 13, Technical Analysis. In this reading, we should have the learning outcomes of being able to explain principles of technical analysis, its applications, and its underlying assumptions. Describe the constructions of different types of technical analysis charts and interpret them. Explain use of trends, support resistance lines, and change in polarity. Describe common chart patterns, describe common technical analysis indicators, price-based momentum oscillators, sentiments, and flows of funds. Explain how technical analysis uses cycles. Describe the key talents of Elo wave theory and the importance of the Fibonacci numbers. Describe intermarket analysis and as it relates to technical analysis and asset allocation. Introduction. Technical analysis has been used by traders and analysts for centuries, but it has only recently achieved broad acceptance among regulators and academic community. This reading gives a brief overview of the field, compares technical analysis with other schools of analysis, and describes some of the main tools in technical analysis. Some applications of technical analysis are subjective. That is, although certain aspects, such as the calculations of indicators, have specific rules and interpretation of finding, it's often subjective and based on long-term context of the security being analyzed. This aspect is similar to fundamental analysis, which has specific rules for calculating ratios, for example, but introduces subjectively it's in the elevation phase. 2. Technical analysis definition and scope. Technical analysis is a form of security analysis that uses price and volume theta and is often geographically displayed. In decision-making, technical analysis can be used for securities in any freely traded market around the globe. A freely traded market is one in which willing buyers trade with willing sellers without external intervention or impediment. Prices are the results of the interactions of supply and demand in real time. Technical analysis is used on a wide range of financial instruments, including equities, bonds, commodity futures, and currency futures. The underlying logic of technical analysis is simply supply and demand determine prices, and the change in supply and demand causes change in prices. Prices can be projected with charts and other technical tools. Technical analysis of any financial instrument does not require detailed knowledge of the instrument as long as the charts represents the actions in a freely traded market. A technician does not need to know the name or type of securities to conduct the analysis. Technical analysis can also be applied over any time frame for short-term price movements to long-term movements of annual closing prices. Trends that are apparent in short-term charts may also appear over long-time frames because fundamental analysis is more time-consuming than technical analysis. Investors with short-term time horizons, such as traders, tends to prefer technical analysis, but not always. For example, fundamental analysts will, with long-term frames, often performs technical analysis in times to purchase and sell of the securities they have analyzed. Through 2.1 principles and assumptions, technical analysis can be thought of as the study of collective investor psychology or sentiment. Price is any freely traded market set by human beings or the automated proxies such as computer trading programs, and price is set at the equilibrium between supply and demand at any instant in time. Various fundamental theorists have proposed that markets are efficient and rational, but technicians believe that humans are often irrational and emotional, and they tend to behave similarly in similar circumstances. Although fundamental data are key inputs in the determination of value, these data are analyzed by humans who may be driven, at least partially, by factors other than rational factors. Human behavior is often erratic and driven by emotion in many aspects of one's life, so technicians conclude that it is unreasonable to believe that investing is the one exception where humans always behave irrationally. Technicians believe that market trends and patterns reflect the irrational human behavior. Thus, technical analysis is the study of market trends or patterns. The technicians believe the trends and patterns tend to repeat themselves and are therefore somewhat predictable. So technicians rely on recognition of patterns that have occurred in the past in an attempt to project future perform patterns of security prices. Another tenet of technical analysis is that the market reflects the collective knowledge and sentiment of many varied participants, and the amount of buying and selling activity in a particular security in a freely traded market. Only those market participants who actually buy or sell a security has an impact on price. And the greater the volume of the participants' trades, the more impact that makes the market participant will have on price. Those with the best information and the most conviction have more say in setting prices than other because the informed traders trade at higher volumes. To make use of their information, however, they must trade. Technical analysis relies on knowledgeable market participants putting this knowledge to work by trading in the markets, thereby influencing price and volume. Without trading, the information is not captured in the charts. Arguably, although insider trading is illegal for a variety of reasons, it improves the efficiency of technical analysis. Trades determines volume and price. The impact occurs instantaneously and frequently anticipates fundamental development correctly. So by studying market technical data, price and volume trades, technicians is seeking to understand investor sentiment. Technicians is benefiting from the wide range of knowledge of market participants and the collective conclusion of market participants about a security. In contrast, the fundamental analysts must wait for the release of financial statements to conduct financial statement analysis. So a long lag occurs between the market activities and the market's conclusion. Charles Dole, creator in 1896 of what is known as the Dow Jones Industrial Average, describes the collective action of participants in the market as follows. The market reflects all the jobbers knows about the conditions of textile trade. All the bankers knows the money market. All the best informed president knows of his own business. Together with his knowledge of all other businesses, it sees the general condition of transportation in a way that the president of no single railroad could ever see. It is better informed on crops than the farmer or even the Department of Agriculture. In fact, the market reduces to a bloodless verdict all knowledge bearing on finance and both domestic and foreign. A similar notion was expressed by George A. Akerlof and Robert J. Schiller. To understand how economies work and how we can manage them and prosper, we must pay attention to the dot patterns of animate people's ideas and feelings, their animal spirits. We will never really understand important economic events unless we comfort the fact that their causes are largely mental in nature. Market participants use many inputs and analytical tools before trading. Fundamental analysis is a key input in determining security prices, but is not the only one. Technical analysts believe that emotions play a role. Investors with a favorable fundamental view may nonetheless sell a financial instrument for other reasons, including pessimistic investor sentiment, marginal costs, and requirements for the capital. For example, to pay a children's college tuition. Technicians do not care why market participants are buying or selling, just that they are doing so. Some financial instruments have an associated income stream that contributes to the security's intrinsic value. Bonds have regular coupon payments. The equity shares may have underlying cash flows or divided streams. A fundamental analyst can adjust these cash flows for risks and use a standard time value of money techniques to determine a present value. Other assets, such as bushels of wheat, gallons of crude oil, or valuation models cannot be used to derive their fundamental intrinsic value. For these analysis is widely used in the analysis of fixed income and equity securities. Technical analysis is widely used in the analysis of commodities, currencies, and futures. Market participants attempt to anticipate economic development and enter into trades profit from them. Technicians believe that security price movement occurs before fundamental development unfolds, certainly before they are reported. This belief is reflected in the fact that stock price are one of the 20 components of the National Bureau of Economic Research's Index of Leading Economic Indicators. A key tenet of technical analysis is that the equity market moves roughly 6 months ahead of inflation points in the broad economy. 2.2 technical and fundamental analysis. Technical analysis and fundamental analysis are both useful and vivid, but they approach the market in different ways. Technicians focus solely on analyzing markets and trading the financial instruments. Fundamental analysis is a much wider field encompassing financial and economic analysis, as well as analysis of the social and political trends. Technicians analyze the results of this extensive fundamental analysis in terms of how it affects market prices. A technician's analysis is derived solely from price and volume data, whereas a fundamental equity analyst analyzes a company and incorporates data that are external to the market and uses this analysis to predict security price movements, to predict security price movements. As the quotation of Dow in section 2.1 illustrates, technical analysis assumes that all of the factors considered by a fundamental analyst are reflected in the price of a financial instrument through buying and selling activity. A key distinction between technical analysis and a fundamental analysis is that the technician has more concrete data, primarily price and volume data, to work with. The financial statements analyzed by fundamental analysts are not objective data, but are the result of numerous estimates and assumptions that have been added together to arrive at the line item of the financial statements. Even the cash line on the balance sheet is subject to corporate management's opinions about which securities are liquid, how many liquid enough to be considered cash. This opinion may be agreed by auditors, and in many countries, regulators who sometimes differ with the auditors. Financial statements are subject to restatement because of such issues as changes in accounting assumptions and even fraud. But the price and volume data used in technical analysis are objective, which the data becomes subject to analysis. However, both types of analysts become subjective because judgment is exercised when a technician analyzes a price chart and when a fundamental analyst analyzes an income statement. Fundamental analysis can be considered to be more theoretically approached because it seeks to determine the underlying long-term or intrinsic value of a security. Technical analysis can be considered to be more practical because a technician studies the market and financial instruments as they exist, even if trading activity appears at times to be irrational. Technicians seek to project the levels at which a financial instrument will trade, whereas fundamental analysis seeks to predict where it should trade. Being a fundamental analyst can be lonely if the analyst is the first to arrive at a fundamental conclusion, even though it is correct, because the deviations from intrinsic value can persist for long periods. The reason these deviations may persist is that it takes buying actively to raise or lower the price of a security in a freely traded market. Drawbacks of technical analysis is that technicians are limited to studying market movements and do not use their predictive analytical models, such as interviewing the customers of a subject company to determine future demand of a company's product. Technicians study market trends, and many are concerned with the securities price trend. in the security trends up, down, or sideways. Trends are driven by collective investor psychology. However, and can change without warning. Additionally, it can take some time for a trend to become evident. Thus, technicians may make wrong calls and have to change their opinions. Technicians are better at identifying market moves and after the moves are already on the way. Moreover, trends and patterns must be in place for some time before they are recognizable. So, a key shortcoming of technical analysis is that it could be late in identifying changes in trends or patterns. This shortcoming mirrors a key shortcoming of fundamental analysis in the securities often outshoot fundamental fair values in an uptrend and undershoot fundamental fair value of downtrends. Strictly relying on price targets obtained by fundamental analysts can lead to closing profitable investment positions too early because investors may irrationally bid securities price well above or well below intrinsic value. Fundamental analysis is a younger field than technical analysis because reliable data are relatively new phenomenon. In contrast, the first record we use of technical analysis was in Japan in the 1700s, where it was used to analyze trading in the rice market. The Japanese developed a detailed field of technical analysis, which their own charts, design, and patterns. The tools were translated to widely understood outside Japan only in the 1980s. Western use of technical analysis were pioneered by Dow, who was also the first editor of the Wall Street Journal. Dow Jones Industrial Average, I think that's where it's from. In the 1890s, as the time publicly traded companies were under no requirements to release their financial information even to shareholders, and insider trading was common and legal. Dow created the Dow Jones Industrial Average and the Dow Jones Railroad Average, now the Transportation Average, as a proxy to gauge the health of the economy. Because fundamental data were not available, by his logic, if industrial stock were doing well, industry companies themselves must be doing well. If railroad stocks were, Not until Securities Exchange Act of 1934, where public companies in the United States required to regularly file financial statements, what were available to the public. In that year, Benjamin Graham published his seminal work, Security Analysis, and 3 years later, he and several others founded the first societies devoted to fundamental analysis, the New York Society of Security Analysts. Fundamental analysis quickly overtook technical analysis in terms of acceptance by practitioners, regulators, and academics. Acceptance of technical analysis by practitioners who received it in 1970 were the creation of the Market Technicians Association in New York and the International Federation of Technical Analysis a few years later. Only in the last decade, however, has the field started to achieve wider acceptance by regulators and academics. An important impediment to acceptance by academic is the difficulty in capturing local securities frequently yield better analysis. Another example of which technical analysis may give an inaccurate reading is in the case of a company that has declared bankruptcy and announced that its shares would have zero value in a restructuring. A technical trend may appear in such case as investors who have short positions buy shares to close out their positions. A good example of when technical analysis is a superior tool to funding analysis in the case of solution fraud, such as occurred in Enron Corporation and WorldCom. These companies who issuing fraudulent financial statements, but many fundamental analysts continue to hold favorable views of the company's equity securities, even as the shape priced is declined. Simultaneously, a small group of investors have came to the opposite view and expressed this view through the high volume sales of the securities. The result were clearly negative charts patterns that could then be discussed by technical analysts. So that's part 2. We'll continue and go into technical analysis tools in our next reading. Okay. Alright, continued reading of the CFA Level 1 program curriculum. Reading 13. Now part 3, technical analysis tools. The primary tools used in technical analysis are charts and indicators. Charts are the graphical displays of price and volume data, and the display may be done in a number of ways. Charts may then subjected to various analysis, including identifications of trends, patterns, and cycles. Technical indicators include a variety of measures of relative price levels, for example, price momentum, market sentiment, and fund flows. We will discuss charts first. 3.1 charts. Charts are an essential component of the technical analysis toolkit. Charts provide information about past price behavior and provide a basis for the inferring likely future price behaviors. A variety of charts can be useful in studying the market. The selection of charts to use in technical analysis is determined by the intended purpose of the analysis. 3.1.1 line charts. Line charts are familiar to all types of analysis and are a simple graphical display of price trends over time. Usually the chart is a plot of data point, such as share price, with a line connecting these points. Line charts are typically drawn with closing prices at the data points. Vertical axis or the y-axis reflects the price levels. The horizontal axis or the x-axis is time. Even though the line chart is the simplest chart, the analysts can quickly gain information from the chart. The chart in Exhibit 1 is a quarterly chart of the FTSE 100 index from 1984 through mid-2009. Up years and down years are clearly evident and strongly rallies from 1984 through 1999, and a market decline from late 1999 to late 2002. Are also clearly visible. The 2003 to 2007 rally did not exceed the high record in 1999, which suggests that investors who are willing to pay as high a price for the stocks on the London Stock Exchange during the rally as they were in prior rallies. This information provides a broad overview of investor sentiment and can lead to further analysis. Importantly, the analyst can assess and analyze this information quickly, collecting and analyzing full array of data normally incorporated in fundamental analysis, which makes it longer. Okay, so we could see increasing the price, peaking in the 1999 and crashing and coming back, but not back to the previous highs, and having the 2008 crash as well. Okay. 3.1.2 bar charts. A line chart has one data point per time interval. A bar chart, in contrast, has 4 bits of data in each entry. The high and low price encountered during the time interval plus the opening and closing prices. Such charts can be constructed for any time period, but are most commonly constructed for daily data. As example 2 shows, a vertical line connects the high and low price of a day. A crosshatch to the right indicates the closing price. The crosshatch to the left indicates the opening price. The appeal of this chart is that the analyst immediately gets a sense of the nature of the day's trading. A short bar indicates little price movement during the day, and that is the high, low, and closing or near the opening price. A long bar indicates a wide divergence between the high and lows for the day. So this is what we call candle bars. Bar chart notation. So the high, it goes up. and a low, it goes down. The opening is here and the closing is here. So this is a positive, right? It opens low and it closes higher. Exhibit 3 shows daily performance of the Brazilian Bovapa index from late 2007 through late 2009. The top part provides the price open, close, highs, and lows. The bottom part shows the volume, for which we'll discuss in section 3.1.6. The downturn in the second half of 2008 is obvious, but also notable, and the extreme price movements in the fourth quarter of 2018 or 2008. There were 40 trading days from 29th of September to 24th of November. On 20 of those days, the closing value of the index has changed from previously by at least 4%. A huge move by historical standards. During the same period, the average daily price range, high to low, was 7% compared to 3.7% in the previous 2 months. This potentially important information will not be captured in a line chart. Candlestick chart. Okay, so that's a little bit different than a candlestick chart. This is just a line chart. Okay, it shows the highs and the lows and how much fluctuation there is in the price. 3.1.3 candlestick chart. Candlestick charts trace the roots to Japan, where the technical analysts have been in use for centuries. Like a bar chart, a candlestick chart also provides 4 price per data point entry, the opening and closing price, and the high and low price during the period. As shown in Exhibit 4, a vertical line represents the range through which the security price traveled during that time period. The line is known as the wick or shadow. The body of its shadow, if the opening price was higher than the closing price, then the body is clearly is clear if the opening price was lower than the closing price. Okay, so that's what it looks like. So if the opening is lower than the closing, there is an increase in price, and that is a clear one. If the opening is below or above the closing price, that indicates a lowering of the decrease in the price, and that is a shadowed. Exhibit 5 shows a weekly candlestick chart of compound via Veil do Rio Doce for a period of 1st of January through 15th of June 2009. So whites are increase and blacks are decreases. The advantage of the candlestick chart over the bar chart is that price moves are much more visible in the candlestick chart, which allows faster analysis. The bar chart indicates market volatility by the height of each bar, but in candlestick charts, the difference between opening and closing prices and the relationship to the highs and lows of the day are clearly apparent. Compared to 6 candles with the 12th in Exhibit 5 in the 6th candle, the analyst can see significant volatility because the high of the day and the low of the day are so far apart. The stock opened near the low of the day and closed near the high, suggesting a steady rally during the day. In contrast, the 12th candle showed that the shares opened and closed at the same price, creating a cross pattern. In Japanese terminology used in candlesticks and charting, this pattern is called a doji. A doji signifies that after a full day of trading, the positive price influence of buyers and the negative price influence of sellers exactly counteracted each other, which tells the analyst that the market is in balance. If a doji occurs at the end of a long uptrend or downtrend, it signals that the trend will probably reverse. 3.1.4 point and figure chart. Point and figure charts were widely used in the United States in the early 1900s and were favored because they were easy to create and update manually. In the era before computers, as with any technical tools, these charts can be used with equities, fixed income securities, commodities, and foreign exchange. With who originated the point and figure chart is unclear. They are referred to in a number of U.S. books dating back to 1898. The methodology involved until 1934, when the first book was published on the topic, The Point and Figure Method of Anticipating Stock Price Movement by Victor de Villers and Owen Taylor, which the advent of powerful charting software and internet websites, complex chart types such as the candlestick charts have become more popular. But point and figure charts still often tremendous value if one knows the limitations of their advantages. The key reason this knowledge is necessary, as explained below, is that point and figure charts are constructed differently from other charts. They have a clear focus on entry and exit levels, but no focus on holding periods. As illustrated in example 6, a point and figure chart is drawn on a graph of consists of x's, columns of x's, alternating with columns of O's. Neither time nor volume are represented on a type of chart. The horizontal axis represents the number of changes in price, not time. Movement along the horizontal axis does not reflect the passage of time, but not in any uniform fashion. The analyst makes entries on a point and figures charts only when the price changes by the box size, which is explained below. The lack of a normal time dimension is perhaps the most unusual characteristic of a point and figure chart. To construct a point and figure chart, the analyst must determine both the box size and the reversal size. Box size refers to the change in price represented by the height of each box. Boxes are generally squared, but the width has no meaning. In example 6, the box size is HK1. The reversal size is used to determine when to create a new column. In example 6, the reversal size is 3, meaning a reversal in price of 3 or more boxes. Although a point and figure chart can be constructed in several ways, these charts are always drawn on graph paper to facilitate seeing the columns and rows nature of the data. The vertical axis measures discrete increments of price. For example, an analyst in Europe may draw a €1 chart, a €2 chart, and other increments. In a €1 chart, boxes will be €1 apart, e.g. 40, 41, 42, where the €2 charts will be €2 apart, which is 40, 42, 44. The most commonly used box size is 1 unit of currency, which is used when the price ranges from 20 to 200 per share of the currency. The next decision the technician needs to make is the reversal size. The most common size is 3, meaning a reversal in price of 3 or more boxes. 3 in the case of box size €1. This use of the multi-box reversal eliminates noise in price data. Noise refers to short-term trading volatility that does not alter the long-term trend of the security. In a point and figure chart, X represents an increase in price and O represents a decline in price. In constructing a chart, the technician draws an X in a column of boxes every time the security prices closes up by the amount of the box size. Ideally, all security prices are considered on an intraday basis. But this practice has given way to use closing prices only if the price increases by twice the box size. The technicians draw 2 X's to fill in 2 boxes, one on top of the other. The technician fills in more boxes for larger price movements. The resulting column starts at the opening price level and extends to the closing price level. As long as the security keeps closing at higher prices, the technician keeps filling the boxes X, which makes the column higher and higher. If the price does not increase by at least the box size, no indication is made on the chart. Thus, in some cases, the chart is not updated for long periods, but no identifications of the passage of time is made on the charts. The reversal size determines when to create a new column. In the case of a €1 box size, the 3-box rehearsal size, a decline of €3 or more would result in the technician shifting to the next column over the beginning of column O's. The first box to be filled is the right and below the highest X in the prior column. The technician then fills in on the O to bring the column down to the price level at the close. Again, each filled-in box, if the box size is €1, represents €1 decline in the security's price. As long as the downtrend continues without a €3 increase in price, the technician continues to add O's to the columns below the prior O's. A reversal in the downtrend by at least the amount of the reversal size prompts the technician to move to the next column and begin drawing a series of X's again. Computer technology makes this process easy, but many technicians prefer to keep point and figure charts on their walls and update them manually because doing so provides a vivid reminder of the market trends. Point and figure charts are particularly useful for making trends decisions because they are clearly illustrated price levels that may signal the end of a decline or advance. They also clearly show price levels at which a security may frequently trade. In using the point size and reversal size to make trading decisions for uptrends or columns of X's, the practitioner would maintain long positions. The reversal size could be considered the amount of loss that would prompt the closing of a long position and the establishment of a new short position. The larger the reversal size, the fewer columns in the chart, and the longer uptrend the downtrend will run. The box size can be varied in relation to the security price. For a security with a very low price, say below €5, a €1 box size might mean few or no updates on the chart because the price would only rarely change by this amount. Thus, the technician can reduce the box size to cents. Highly priced security, much larger box size could be used. The reversal size is a multiple of the box size, so if the box size is changed, the reversal size changes. Practitioners who want fewer columns or trade signals can use a large reversal size. Analysis of a point and figure chart is relatively straightforward as long as the technician understands its construction and limits. The chart is relatively simple and repeated high and low prices are evident by a series of short columns of X's and O's spanning roughly the same price range. Many sustained price moves are represented by long columns of X's when prices are moved up, or O's when prices are moved down. 3.1.5 scale. For any chart line, bar, or candlestick, the vertical axis can be constructed by either a linear scale known as the arithmetic scale or the logarithmic scale, depending on how you want to view the data. With a logarithmic scale, equal vertical distance on the chart correspond to an equal percentage change, and logarithmic scale is appropriate when the data moves through a range of values representing several orders of magnitude, e.g. from 10 to 10,000. A linear scale is better. Consider Exhibit 7 and 8, which both shows yearly historical yearly history of the Dow Jones Industrial Average from 1928 to 2010. Plotting the index on a linear scale as in Exhibit 7 makes it difficult to gather much information from the first 50 years of the data series. Analysts could see a slight uptrend, but not much else. The eye is drawn to the bull market of the 1980s and subsequent dot-com bubble and the recent era, the subprime crisis. When plotted on a logarithmic scale in Exhibit 8, however, many people will find the data to tell more comprehensive story. The Great Depression of the 1930s stand out, but over the following 75 years, the following a relatively stable upward trend. Yeah, so this is what it looks like. Dow Jones Industrial Average between 1928 and 2010. Dow Jones Industrial Average on a logarithmic scale, also during the same period. Okay. 3.1.6 volume. Volume is an important characteristic that is included at the bottom of many charts. See, for example, Exhibit 3. Volume is used to assess the strength or conviction of buyers and sellers in determining a security's price. For example, on a daily price chart, below the price section would be a column price showing the volume traded for the day. Some technicians consider volume information to be crucial. If a volume increases during a time frame in which price is also increasing, that combination is considered positive, and the two indicators are said to conform each other. The signal would be interpreted to mean that over time, more and more investors are buying the financial instruments, and they are doing so at higher and higher prices. The pattern is considered a positive technical development. Conversely, if volume and price diverge, for example, if a stock price rises while its volume declines, the implication is that fewer and fewer participants are willing to buy the stock at the new price. If this trend in volume continues, the price rally would soon end because demand for the security at higher prices will cease. Exhibit 9 shows a chart for Toronto Dominion Bank or TD Bank with volume displayed separately. So volume is at the bottom, indicating how much on this stock is being traded at, and how much volume there is trading within this stock. 3.1.7, we got the time intervals. Most of the chart examples in this reading are daily price charts, in that they show the price and volume on a daily basis. Daily frequency is not required, however, because charts can be constructed by using any time interval. For long-term investing, an analyst can use weekly, monthly, or even annual intervals. The same analytical approach applies irrespective of the time interval. Using long intervals allows the analyst to chart longer time periods, and thus using short time intervals for the simple reason that long intervals contain fewer data points, so a longer time frame can be presented on the chart. Using short intervals allows the analyst to see more detail. A useful step for many analysts is to begin the analysis of a security from the chart for a long time frame, such as a weekly or monthly chart, and then construct charts with shorter and shorter time intervals, such as daily or hourly charts. 3.1.8 Relative strength analysis. Relative strength analysis is widely used to compare the performance of a particular asset, such as a common stock, with that of some benchmarks, such as in the case of common stock, the FTSE 100, the Nikolai 225, and the S&P 500 index, or the performance of another security. The intent is to show out or underperformance of the individual issues relative to some other index or asset. Typically, the analyst prepares a line chart of the ratio of two prices, with the asset price analysis as the numerator, and with the benchmark or other security as the denominator. A rising line shows the asset is performing better and then the index or other stock. A declining line shows the opposite. A flat line shows a neutral performance. Suppose a private investor is researching two investment ideas. She reads about Harley Davidson Motor Company, or HOG, is a well-known motorcycle company. Rodman Rancer is a small investment bank. The two investors want to determine which of these two has been the stronger performance relative to the S&P 500 under the past few months. Exhibit 10 shows relative strength lines for the two stocks for the first 6 months of 2009. Each point on the relative strength plot is simply the ratio of the sharp price of the S&P 500. For example, on 9th of March, we don't have to go into the examples. The units on the vertical axis are not significant. The ratio is a function of the relative price of the asset under consideration. The important information is have the ratio has changed. This type of chart follows .2 Trends. The concept of a trend is perhaps the most important aspect of technical analysis. Trends analysis is based on the observation that market participants tend to act in herds and that trends tend to stay in place for some time. A security can be considered to be an upwards trend, a downward trend, a sideways trend, or a non-apparent trend. Not all securities are in a trend. Like little useful forecasting information can be glanced from a technical analysis when a security is not in a trend. Not every chart will have obvious or clear implications, so the analyst must avoid the temptation to force a conclusion for every chart and thus reaching a wrong interpretation. An uptrend for a security is when the price goes up. When the price goes to higher highs and lower lows as the security moves up in price, each subsequent new high is higher than the prior high, and each time there is a retractment, which is a reversal in the movement of the security's price, and must stop at a higher low than the prior lows in the trend place and in the trend period. To draw uptrend lines, the technician draws a line connecting the lows and the price chart's major breakdown in place. However, when the price drops through below the trend line by significant amounts. Many technicians uses the 5 to 10% below the trend line indicates that the upward trend is over and may signal a further decline in the price. Minor breakthroughs below the previous lows simply call for the line to be moderately adjusted over time. Time is also a consideration in trends. The longer the security price stays below the trend line, the more meaningful the breakdown is considered to be. In an uptrend, the factors of demand are greater than the forces of supply. So traders are willing to pay higher and higher prices for the same asset over time. Presumably, the strong demand and indicates that investors believe the intrinsic value of the security is increasing. A downtrend is when a security makes lower lows and lower highs. As a security moves down in price, each subsequent new high must be lower than the prior high, and each time there is a retracement, it must stop at a lower low than a prior lows in the trend period. To draw a downtrend line, a technician draws a line connecting the highs of the price chart. Major breakouts above and downtrend lines, e.g. the 5 to 10% indicates that the downtrend is over and a rise in the security's price may occur. And as a willing uptrend, the longer the security price stays above the trend line, the more meaningful the breakout is considered to be. In a downtrend, supply is overwhelmingly demand. Over time, sellers are willing to accept lower and lower prices to exit long positions or enter new short positions, but motives of the seller generally indicates deterioration in investor sentiment about the asset. However, selling may be prompted by factors of production. A security may trade in a fairly narrow range, moving sideways on the price charts without much upwards or downwards movement. This pattern indicates a relative balance between supply and demand. A technical analyst may not expect the profit long or short trades in such scenarios, but might devise profitable options trading for short-term investors. The ability to accept the risk. Exhibit 11 shows the application of trend analysis depicted is an uptrend line for shares of China Mobile Legends. Mobile Limited notes that through late 2007, every rally took the share to a new high, whereas sell-offs stopped at increasingly higher levels. The first sign of trouble came in the spring of 2008, when the rally terminated at a lower price point than the prior rally. In late 2007, the movement was followed by the shares breaking through the trend line. Here's the chart. The chart in Exhibit 11 covers roughly 7 years and would most likely be used by investors when a long-term horizon. Investors with a shorter horizon might use a chart with a shorter time frame and would thus obtain a different trend line, as well as a different trend line breakdown. Two concepts related to trend lines are supported and resistance. Support and resistance. Support is defined as a low price range in which buying activity is sufficient to stop the decline in price. And the opposite of resistance, which is a price range in which selling is significant to stop the rise in price. The psychology behind the concepts of support and resistance is that investors have come to collective consensus about the price of a security. Suppose a support and resistance level can be sloped lines, as in trend lines, or horizontal lines. A key tenet of support and resistance as a part of technical analysis is the change in polarity principles, which states that once support level is breached, it becomes a resistance level. The same holds true for resistance levels. Once breached, they become support levels. For example, if the price of a security never rises above this over a long period of time and begins to decline after time, it reaches this level, but then finally breaks through this level by a significant amount. The point to which the price raises becomes a support level. Support at the resistance level are commonly rounded numbers. Support indicates that at some price level, investors consider securities to be attractive investments and are willing to buy even in the wake of sharp declines. For resistance at some level, investors are not willing to buy even in an uptrend. The fact that these price points tend to be round numbers strongly suggests that human sentiment is at work. One of the most widely publicized example of support and resistance is when the DJIA broke through the 10,000 mark in 1999. Shown in Exhibit 12, previously 10,000 has been viewed as a resistance line. But from 1999 through the end of the chart in 2001, 10,000 served as a support line. 3.3 chart patterns. Chart patterns are formations that appears in price charts and creates some type of recognizable shape. Common patterns appears repeatedly and often lead to similar subsequent price movements. Thus, the identification of an analysis of chart patterns is a common aspect of technical analysis used to predict security prices. An important connection to understand is that patterns from as a result of the behavior of market participants, and that these patterns represent geographically depictions of the collective psychology of the markets at a given time. The reoccurring pattern that occurs in charts can be used as a basis for market forecasting. The reason charts patterns have a predictive value is that they are graphic representations of human trading activities, and human behaviors is frequently repeated, especially trading activity that is driven by fear in market sell-offs or hope and greed, as evidenced in bubbles, that is rallies that extend well beyond valuation levels that would be derived by fundamental values. An example of a rally driven by greed is the recent real estate bubble, which took home prices to unsustainable high levels. This bubble started a few years after the internet stock bubble of the 1990s, which also took prices to unsustainable high levels. In bubbles, investors driven by hope and greed drive the prices of an asset irrationally high levels. In the expectation of another day, buyers would be willing to pay or even higher prices for the asset. The housing bubble was notable because it was so closely followed by the internet stock bubble. Despite all had been written about the irrational exuberance of the internet bubble in the 1990s, chart patterns can be divided into two categories: reversal patterns and continuation patterns. These terms refers to the trend of the society in question prior And question: prior to the information of the pattern, the most important concept to understand reversal patterns. As the name implies, a reversal pattern signals the end of a trend, a change in direction of a financial instrument price. Evidence that the trend is about to change direction is obviously important. So inversal patterns are noteworthy. Head and shoulders. Perhaps the most widely recognized pattern is the head and shoulders pattern. The pattern consists of 3 segments. The volume of an important characteristic is interpreting this pattern. Because head and shoulders indicates a trend reversal, a clear trend must exist prior to the formation of the patterns in order for the patterns to have a predictive validity. For head and shoulders patterns, the prior trend must be an uptrend. Later, we will discuss the inverse head and shoulders pattern preceded by a downtrend. Exhibit 13 depicts a head and shoulder patterns for Marvell Technology Groups during 2006. The 3 parts of the patterns are as follows. The left shoulders, this part appears to show a strong rally, with the slope of the rally being greater than the prior uptrends. A strong volume, the rally then reverses back to the price level where it states, forming an inverted V pattern, but on lower level. The head is the more pronounced version of the left shoulder. A rally first follows the... Okay, so this is what it looks like. The shoulder is one V, the head is another V, and the shoulder is another V, and the neckline is at the baseline of when the shoulder starts. That's basically it. Rallies with an analyst. What is this called? The head and shoulders pattern. Shoulders, head, shoulders. The head and shoulders pattern. Rarely when an analyst see a perfectly formed head and shoulders pattern. Variations include 2 tops of the shoulders or on the head. The head, however, should rise to a higher price level than either shoulders, whereas the shoulders should be roughly symmetrical. And each term of the neckline price level, the first rally should begin at this level, and the left shoulder and head should decline to roughly this level, but neckline may not always from exactly horizontal lines. This imperfect variation makes this and other technical patterns difficult for quantitative analysis or academicians to model, but the human brain can detect the pattern even if it is imperfectly formed. Volume is important in analyzing head and shoulders patterns. A new high in price at the top of the head without a new high in volume signals a fewer bullish market participants. When one indicator is making a new high or low, but another is not, the situation is called divergence. In divergence, the right shoulders will have even lower volume, signaling that buying interest or demand is tapering off and will soon be overwhelmed by supply. This result will be a price decline. Once the head and shoulder patterns have formed, the expectations is that the share price will decline down through the neckline price. The technicians tend to use filtering rules to make sure that a clear breakthrough of the neckline has occurred. These rules may take the form of waiting to trade until the price falls to a meaningful level below the neckline. 3% or 5% are commonly used, and or a time limit for the price to remain below the neckline before trading. when a daily price chart is used, the rule may be several days to a week. Prices commonly rebound to the neckline level even after a decline has exceeded the filter level. Prices generally stop, however, at or around the neckline. The neckline will what was a support level under the change in polarity principles. Once a support level is breached, it becomes a resistance level. 3.3.1.2 Inverse head and shoulders. The head and shoulders patterns can also form upside down and act as a reversal pattern for a preceding downtrend. The three parts of the inverse head and shoulders. Okay, the left shoulder appears to have a strong decline with a slope. So it's basically the shoulder both inverse, okay? So that's what it looks like. The shoulder, the head, and the shoulder with a neckline like that. Okay, example 1. Let's see. Determining a price target for a head and shoulder patterns. Danielle Waterhouse is a technical analyst for Kinetic Securities. Okay, wait, let me drink my coconut water really fast. I bought this can of coconut water, if you guys were wondering what I've been drinking recently. I mean, it's a little bit overpriced, but it's so good. A little bit too sweet, a little bit too overpriced, but it's so good. It's light, it's smooth, and it's perfect. Yeah. One of the companies in her firm follows is LPA Petroleum. Waterhouse believes that a graph of the LPA's share prices over the past 6 months reveals a classic head and shoulders pattern. The prices peaked at 108. She estimated the neckline at 79. At today's choice, the shares trading at 78 based on the head and shoulders pattern. What price target should Waterhouse estimate? Waterhouse estimates the neckline at $79, which is 108 minus 79 or 29 lower than at its head. The price target thus is 79 minus 29, which is 50. Waterhouse should attempt to sell the LPA short at today's price of 78 and anticipate closing positions at US $50 for a profit of 28 per share, not accounting for transaction costs, of course. Setting price targets with inverse head and shoulders pattern. Calculating price targets for inverse head and shoulder patterns is similar to the process of head and shoulders patterns, but in this case, because the pattern predicts the end of a downtrend, the technicians calculates how high the price is expected to rise once it breaches the neckline. Exhibit 15 illustrates an inverse head and shoulder pattern. Okay, so we have an inverse head. So we have an inverse shoulder, we have an inverse head, and we have an inverse shoulder again. So that they are taking dips now. For an inverse head and inverse shoulder pattern, the formula is similar to the head and shoulder pattern. The price target is equal to the neckline plus the neckline minus the head. For example, in the price chart in Exhibit 15, the low price reached at the bottom of the head is roughly this much, and the neckline is roughly this much. The target can thus be formed as this much. In the case, the technician may have taken a long position for the summer of 2003 with the hope of eventually exiting the position at about US this for a profit. Okay, so 3.3.1.5 double tops and bottoms A double top. So these are some more models for that. Double tops and bottom A double tops is when uptrend reverses twice as roughly the same high price levels. Typically, volume is lower on the second high than on the first high, signaling a diminishing of demand. The longer the time is between the two tops, And the deeper the sell-off is after the first top, the more significant the pattern is considered to be. Price targets can be calculated from this pattern in a manner similar to the calculations for the head and shoulder pattern. For a double top, price is expected to decline below the level of the value between the two tops by at least the distance from the valley low to the high of the double tops. Example 2, determining a price target from a double top pattern. Richard Dupuis is a technician who trades at Euro-dollar futures. For his own account, he analyzes charts based on 1-minute time intervals, looking for stock to short-term trading opportunities. Euro-dollar futures contracts have been trading upwards upward most of the morning, but Dupuis now observes that what he believes is a double top pattern after peaking at US $97. The future contract prices falls to 96.42, climbed against the 97.02, and then started to decline because of the double top. Dupuis anticipated a reversal from the uptrend to a downtrend. Dupuis decided to open a short positions to capitalize on the anticipated trend reversal. What price should Dupuis estimate for closing the position? So you take this subtract by this and this, you get that. Double bottom are formed when the price reaches a low, rebounds, and it sells off back to the first low level. Exhibit 16 depicts a double bottom pattern for Time Warner technicians. Use the double bottom to predict price change from a downtrend to an uptrend in security prices. For double bottoms, the price is expected to anticipate above the peak between the two bottoms by at least the distance from the valley lows to the peak. So we have a bottom, we rebound a little bit, and we have another bottom. Of course, we also have the volume data. Triple tops and bottoms. Triple tops consists of 3 peaks at roughly the same price levels. The triple bottom consists of three toughs at roughly the same price levels. A triple top for Rockwell Automations during 1999 is shown in Exhibit 17. Exhibit 17 shows this. Okay, what do we see? The triple top pattern. Here's one top, here's another top, and here's another top. So this is what we call the triple top. One of the challenges of double top and triple top patterns, and one of the valid criticism of technical analysis in general, is that analysts cannot know which patterns will resolve after each, until after the fact. For example, after the broad... Let me drink some more coconut water. It's so good. Literally, just crack a coconut open, you will get this pristine coconut water, man. I'm not even kidding you, it's so good. Yeah, for example, after the broad equity market sell-off in the first quarter of 2009, a number of investment professionals were quoted as calling for a retest of the lows. In technical terms, a double bottom. There is no evidence that the market correction or rallies must end with a double bottom or double top in the case of an uptrend. And there is no generally accepted theoretical theory that predicts whether a low will be repeated once or even twice before a reversal occurs. A double bottom is considered to be more significant pattern than a single bottom because traders have stepped in on 2 occasions to halt declines. However, traders have no way to determine whether a double top or double bottom will be followed by a third top or bottom. Triple tops and triple bottoms are rare, but when they occur, they are more significant reversal patterns than double tops and double bottoms. On 3 separate occasions, traders step in to sell or buy shares with enough volume and end a rally or decline underway at time. Nevertheless, the greater the number of times the price reversal at the same level, the greater the time interval over which the pattern occurs, the greater the significance of the pattern. 3.3.2 Continuation patterns. A continuation patterns is used to predict the resumption of a market trend that was in place prior to the formation of a pattern. For a supply and demand standpoint, a continuation pattern indicates a change in ownership from one group of investors to another. For example, if a positive trend was in place prior to a pattern, then one group of investors begins selling, the negative impact on price is quickly offset by other investors buying. So the forces of supply and demand go back and forth in terms of their impact on price. But neither has an overwhelming advantage. This type of pattern is often called a healthy correction because the long-term market trends does not change, and because one set of investors is seeking to exit, they are replaced by another set of investors willing to take their positions at roughly the same share price. More patterns. Okay. 3.3.2.1 Triangles and triangle patterns are the type of continuation patterns. Continuation patterns. They come in three forms: symmetrical triangles, ascending triangles, and descending triangles. A triangle patterns forms as a range between high and low price narrows, visually forming a triangle. In old terminology, triangles were referred to as coils, which is where the synonym which was also synonymous with strings. No, springs, because a triangle was considered analogous to a spring being wounded up tighter and tighter and storing energy that would at some point be released. In a triangle, a trend line connects the highs, and the trend line connects the lows. As the distance between the highs and the lows narrows, the trend line meets, forming a triangle. In a daily price chart, a triangle pattern usually forms over a period of several weeks. In an ascending triangle, as shown in Exhibit 18, the trend line connecting the high price is horizontal, and the trend line connecting the low price forms an uptrend. What this pattern means is that market participants are selling the stock at the same price levels over a period of time, putting a halt to rallies at the same price point. But the buyers are getting more and more bullish and stepping in at increasingly higher prices to halt sell-offs instead of waiting for further price declines. As an ascending triangle typically forms in an uptrend, the horizontal line represents sellers taking profit at around the same price point, presumably because they believe that this price represents the fundamental intrinsic value of the security. The fact that the rally continues beyond a triangle, So this is what the ascending triangle pattern looks like. And the descending triangle shown in figure 19, the lower price from the horizontal triangle line, trend line, and the higher prices from a series of lower and lower highs. Typically, a descending triangle will form in a downturn at some point, and the sell-off buyers appear with enough demand to halt sell-offs enough time they occur at around the same price. Again, this phenomenon may be the result of fundamental analysis believing that the securities has reached a price where it represents a significant discount to its intrinsic value, and these analysts step in and buy as a triangle forms. Each rally ceases at a lower and lower high price point, suggesting the selling demand is exerting greater price influence than buying demand. This is what a descending triangle looks like. In a symmetrical triangle, the trend line formed by the highs and angles down, and the trend lines formed by the low angles up. Both are roughly the same angles, forming a symmetrical pattern. Exhibit 20 contains a symmetrical trend line by the price of transaction transocean in early 2000, when the triangle indicates that the buyers are becoming more bullish while simultaneously the sellers are becoming more bearish, because that's more of a symmetrical trend line. The term measuring implication refers to the height of a triangle as illustrated with the dark vertical bars in Exhibit 20. The measures of implications is derived by calculating the difference in price from the two trend lines at the start of the triangle. Once the pattern is broken and the price breaks through one of these trend lines that from the triangle, the analyst expects the price to move, but at least the amount of the breakthrough above or below the trend line. Typically, price breaks out of a triangle pattern between halfway and 3/4 of the way through the pattern. The longer the triangle pattern persists, the more volatile and sustained the subsequent price movement is likely to be. 3.3.2.2 rectangle patterns. Okay. Another sip of coconut water. A rectangle pattern is a continuation pattern formed by two parallel trend lines, one formed by connecting the high prices during the pattern and other formed by the lows. Exhibit 21 shows two rectangular patterns. As in the case with other patterns, the rectangle pattern is a graphical representation of what has been occurring in terms of collective market sentiment. The horizontal resistance line that forms the top of the rectangle shows that investors are repeatedly selling shares at a specific price level, bringing rallies to an end. The horizontal support line forming the bottom of the rectangle indicates that traders are repeatedly making large enough purchases at the same price level to reverse declines. The support level is a bullish rectangle in nature because the long-term trend in the market is bullish. This resistance line may simply represent investors taking profit. Conversely, in a bearish rectangle, the support line may represent investors buying the security. Again, the technician is not concerned with why a pattern has formed, only with the likely next price movement once the price breaks out of the pattern. So here's the rectangular pattern. We take the bottom prices, we take the upper prices, we put them together, and we get a rectangle. And the left hand side we have a bullish rectangle, and the right hand side we have a bearish rectangle. Okay. 3.3.2.3. That's like a wrap. Okay. Flags and pennants. Flags and pennants are considered minor continuation patterns because they form over short periods of time, over a daily price chart, typically over a week. They are similar to each other. They have the same uses. A flag is formed by parallel trend lines in the same way that most countries' flags are rectangular and create a parallelogram. Typically, the trend line slopes is a direction opposite to the trend up trend up to that time. For example, in an uptrend, they slope down. A pennant formation is similar, except that the trend lines converge to form a triangle similar to the pennants of many sport teams or pennants flown on ships. The key difference between the triangle and the pennant is a short-term formation, whereas the triangle is a long-term formation. Okay, so here's the pennant. The expectation for both flags and pennants in the trend will continue after the pattern in the same direction is it was going prior to the pattern. The price is expected to change by at least the same amount as the price changes from the start of the trend to the formation of the flag or pennant. In example 22, a downtrend begins at point A, which is 104, at point B, which is 70. The pennant begins to form. This distance from point A to point B is 34. The pennant ends at point C, which is 76. The price target is 76 minus 34, which is 42, as labeled in D. Okay, we're going to end today's reading at this part, and we're going to continue our next part and finish reading 13 and technical analysis tomorrow. Okay, I hope to see you guys there, and without further ado, goodbye. Continued reading of the CFA Level 1 program curriculum. Technical indicators. The technical analyst uses a variety of technical indicators to supplement the information gleaned from charts. A technical indicator is any measure based on price, market sentiments, or other or funds flows that can be used to predict changes in price. These indicators often have a supply and demand underpinning. That is, they measure how potential changes in supply and demand might affect the security's price. 3.4.1 price-based indicators. Price-based indicators somehow incorporate information contained in the current and past history of market prices. Indicators of this price range from simple, e.g. Moving average, or complex, e.g. Stochastic oscillator. 3.4.1.1 moving average. Moving average is the average of the closing price of a securities over a specified number of periods. Moving averages smooth out short-term price fluctuations, giving the technicians a clearer image of market trends. Technicians commonly use a simple moving average, which weighs each price equity in the calculation of the average price. Some technicians prefer to use an exponential moving average, also called an exponentially smooth moving average, which gives the greatest weight of recent price while giving exponentially less weight to older prices. The number of data points included the moving average depends on the intended use of the moving average. A 20-day moving average is commonly used because a month contains roughly 20 trading days. Also, 60 days is commonly used because it represents a quarter year or 3 months of trading activity. Moving averages can be used in conjunction with a price trend or in conjunction with one another. Moving averages are also used to determine support and resistance. Because a moving average is less volatile than price, this tool can be used in several ways. First, whether price is above or below its moving average is important. A security that has been trending down in price will trade below its moving average, and a security that has been trending up will trade above its moving average. Second, the distance between the moving average line and the price is also significant. Once price begins to move up towards the moving average line, the line can serve as a resistance level. The 65-day moving average line is commonly cited in the press. When the price approaches the moving average line, many investors become concerned that a rally will stall, so they sell the security. 2 or more moving averages can be used in conjunction. Exhibit 23 shows the price chart of Gazprom SP European Depository receipts on the Frankfurt Stock Exchange, overlaid in with 20 days and 60 days EDR moving averages for late 2007 to mid 2009. Note that the longer the time frame used in the creation of the moving average, the smoother and less volatile the line. Investors often use moving averages crossovers to buy or sell signals. When a short-term moving average crosses from underneath a longer term, this movement is considered bullish and termed a golden cross. Conversely, when a short-term moving average crosses above the long-term moving average, the movement average is considered a bearish and is called a dead cross. In the case as shown as example 23, a trending strategy of buying on golden cross and selling on dead cross would have been profitable. So just looking at the moving average of the recent and the past. Moving averages are easiest to construct, and simple trading rules can be derived for using them. Computers can optimize what time lengths to set when using 2 moving averages. This optimization may take the form of changing the number of days included in each moving average or adding filter rules, such as waiting several days after a trade signal is given to make make a trade. Reasons for optimization include the desire to manage capital downturns, to manage gains, or to minimize losses. Once the moving average is optimized, even if a profitable trading system is devised for that security, the strategy is unlikely to work for other securities, especially if they are dissimilar. Also, as market conditions change, a previously optimized trading system may no longer work. 3.4.1.2, the Bollinger Bands. Market veteran John Bollinger combined his knowledge of technical analysis with his knowledge of statistics to create an indicator called the Bollinger Band. The Bollinger Band consists of moving averages plus a higher line representing the moving average plus a set of numbers of standard deviation from average price for the same number of periods as used to calculate the moving average, and a lower line that is a moving average minus the same number of standard deviation. Example 24 depicts a Bollinger Bands for the Gazprom EDR. So moving averages for the different time durations. The more volatile security being analyzed becomes, the wider the range becomes between the two outer lines. Or bands. Similarly to move averages, Bollinger Bands can be used to create trading strategies that can be easily computerized and tested. A common use is as a constrained strategy in which the investor sells when a security price reaches the upper band and buys when it reaches the lower band. This strategy assumes that the security price will stay within the bands. This type of strategy is likely to lead to a large number of trades, but it also limits risk because the trader can quickly exit unprofitable trades in the event of a sharp price move and a change in trend. However, a contrarian strategy based on Bollinger's bands would be unprofitable, so long-term investors might actually buy on a significant breakout, able to above the upper boundary band, because a majority breakout would imply a change in trend likely to persist for some time. The long-term investor will sell on a significant breakout below the lower band. In this strategy, significance will be defined as breaking above or below the band by a certain percentage, say 5% or 10%, and or for a certain period of time, say a week, for a daily price chart. Again, such rules can easily be computerized and tested. 3.4.2 momentum oscillators. One of the key challenges is using indicators overlaid on a price chart is the difficulty of discerning changes on market sentiment that are out of the ordinary. Momentum oscillators are intended to alleviate this problem. They are constructed from price data but are calculated so that either oscillations between high and low, typically 0 and 100, are oscillated around a number such as 0 or 100. Because of this construction, extreme high or lows are easily discernible. These extremes can be viewed as a graphic representation of market sentiment when selling or buying activity is more aggressive than historically typical, because they are price-based. Momentum oscillations also can be analyzed by using the same tool technicians use to analyze price, such as the concept of trends, support, and resistance. Technicians also look for convergence or divergence between oscillators. Price convergence is when the oscillator moves in the same manner as the security being analyzed. The divergence is when the oscillator moves differently from the security. For example, when price reaches a new high, the sign is considered bullish, but if the momentum oscillator being used does not also reach a new high at the same time, this pattern is divergent. It is considered to be early a warning of weakness and indication that the uptrend may soon end. Momentum oscillators should be used in conjunction with an understanding of the existing market or price trend. Oscillator alerts a trader to overbought or oversold conditions In an overbought conditions, market sentiment is unsustainably bullish. In an oversold conditions, market sentiment is unsustainably bearish. In other words, the oscillator range must be considered separately for every security. Some securities may experience wide variations and others may experience very minor variations. Oscillators have three main uses. First, oscillators can be used to determine the strength of a trend. Extreme overbought levels of warning signals for uptrends, and extreme oversold levels are warning signals for downtrends. Second, when oscillators reach historically high or historically low levels, they may be signaling a pending trend reversal. For oscillators that move above or below zero, crossing the zero lines level signifies a change in the direction of the trend. For oscillators that move above and below 100, crossing the 100 level signals a change in the direction of the trend. Third, in a non-trending market, oscillators can be used for short-term trading decisions, that is, to sell at overbought levels and to buy at undersold levels. 3.4 for 2.1 momentum or rate of change oscillators. The term momentum oscillator and rate of change oscillator is synonymous with rate of change. Is often abbreviated as ROC. Oh, not the Republic of China. Interesting. Republic of China would be Taiwan. The ROC oscillator is calculated by taking the most recent closing price subtracted by the closing price from a prior date. That is a set of numbers of days in the past, and multiplying the result by 100, which will give us M equals V minus Vx multiplied by 100, and these are what it means individually. When the ROC oscillator crosses zero in the same direction as the direction of the trend, the movement is considered a buy or sell signal. For example, if the ROC oscillator crosses into positive territory during an uptrend, it is a buy signal. If it enters negative territory during a downtrend, it is considered a sell signal. The technician will ignore crossovers in opposition to trend because the technicians may always first take into account the general trend when using oscillators. An alternative method of constructing this oscillator is to set it so that the oscillators above and below 100 instead of 0 are as follows. In Exhibit 25, the calculation method for ROC is the rate of change oscillator for Toyota stock trading on the Tokyo Stock Exchange is for the oscillator to move around 100 and X is 12 days. Note that for the stock, the ROC oscillator tends to maintain a range between 85 and 115 yen. Episodes when the oscillator moves along outside this range are of particular interest to the technician. Extremely high means that the stock has posed its highest gains in any 12-day period at the point, and with extremely low readings means that has posted greatest losses over the 12-day period. When investors bid of the price of the security too rapidly, the indications is that the sentiment may be underlying bullish. And the market may be overbought. Exhibit 25 shows that overbought levels of ROC oscillators coincide with temporary highs in stock price. So these levels would have been signals to sell the stock. The other notable aspect of example 25 is it would have been signals to sell the stocks. The other notable aspects of Exhibit 25 is a divergence when the share price hits a new low in December 2008, but the ROC oscillator does not. The divergence would have been a bullish signal and would have been interpreted to mean that although the share price hits a new low, investor sentiment will accurately higher that high or was actually higher than it was previously, and in itself the information would not have been enough to warrant buying the shares because a downtrend in price was still in place. (3.4.2.2) relative strength index. A relative strength index, or RSI, is computed over a rolling time period. It graphically compares a security's gains with its losses over the set period. The creator RSI, Willis Wilder, suggests a 14-day period, and this time period is generally the period used in most technical analysis software. The technician should understand that the variable can change and that the optimal time range should be determined by how the technician intends to use the RSI. Information factors that influence selection of the time period are similar to those that influence the time period of moving averages. Short time periods, such as 14 days, provide information about the short-term price behavior, and if a 200-day is used, this short-term information will be smoothed out and perhaps will disappear at all. Will not be apparent at all. RSI is the momentum oscillator and is not to be confused with the charting method, called the relative strength analysis, in which the ratio of two security prices is plotted over time. The RSI provides information on whether or not an asset is overbought. The formula for RSI is not intuitive and best understood with an example. The formula is this. Example 26 shows closing prices for Ford Motor Company during the month of June 2006 or 2009. During this time, we were still rebounded by the subprime crisis. Automobile company stocks were unusually volatile, and some speculators presented investment short-term trading opportunities. Suppose a trader decides to compute an RSI for the month of June. It would be 22 days. RSI would be 21 price changes, 11 up, 9 down, and 1 unchanged. The calculated RSI, the trader would sum the 11 up charges, which is sum of 1.45. The down changes total of negative 1.51. The absolute value drops the minus signs and the ratio. So as illustrated right here, the index construction forces the RSI to lie within 0 and 100. A value above 70 represents an overbought situation. Values below 30 suggest the asset is oversold. Again, as in the case with most technical data, the 30-70 range is a good rule of thumb, but because of the oscillator's measure of volatility, less volatile stocks, such as utilities, may normally trade in much narrower ranges. More volatile stocks, such as small capitalization technology stocks, may trade in wider ranges. The range also does not appear to have a symmetrical around 50. For example, in an uptrend, one might see a range of 40 to 80, but a downtrend of 20 to 60. The RSI measures often appears at the bottom or top of the price chart. Exhibit 27 shows the candlestick chart for Ford stock in 2909. The candlestick chart of Ford stock price in Exhibit 27 illustrates several aspects of the use of an RSI. For example, because the RSI oscillator was higher than 20 ON, 23rd March, so the stock was overbought at the time. A simple reading on the chart might have led to the conclusion that the trader should sell the stock. Doing so, however, would have causes the trader to miss a significant advance in the shares. A careful technician analysis that took into account the trend would have identified in the stock was not to be was in an uptrend. The RSI reading above about the 70 could be expected because RSI is a price-based oscillator. The trader can also apply trend lines to analyze it. Notre Dame that belongs 3.4.2.3 scholastic oscillator. The scholastic oscillator is based on the observation that is uptrend prices tend to close at or near the high end of their recent range, and downtrends they tend to close near or lower. The logic behind this pattern is that if a share is of a stock price consistently bid up the day, but is lose value by the close, continuation of rally is doubtful. If sellers have enough supply to overwhelm buyers, the rally is suspected. If a stock rally during the day is able to hold on the stock or most of the gains by the close, the stock is the sign is bullish. The stochastic oscillator oscillates between 0 and 100 and has a default setting of 14-day periods, which again might be adjusted for the situation. As we discussed in RSI, the oscillator will compose of two lines called percentage Q and percentage D that will be calculated as follows. Analysts should think about percentage D the same way a long-term moving average line is in conjunction with the short-term line. The K value means that the largest value the latest closing price K was in the K percentile of the high-low range, or the H14 and L14, H14. The default oversold or overbought range for the stochastic oscillator is based on a reading in the signal lines relative to the reading of 20 and 80. But warnings about always using the default range for the RSI oscillator also applies in the case for the stochastic oscillator. In fact, note to technicians, Constance Brown has coined a term of stochastic default club to refer of neophyte technicians who trade based solely on these defaults. She has reported being able to develop successful trading strategies by using a time frame shorter than 14-day default to calculate this stochastic oscillator. Apparently, enough traders are basing trades on defaults to move the market for a certain stocks. So using shorter time frames then the default, she could trade ahead of the traders in the default stochastic club and generate a profit. Of course, other traders might be tempted to use an even shorter time frame, but there is a drawback to using a short time frame. Namely, the shorter the time frame, the more volatile the oscillator becomes and the more false signals it generates. Stochastic oscillators should be used with other technicians' tools such as trend analysis and pattern analysis. If both methods suggest the same conclusion, traders have a convergence or confirmation, but if they give conflicting signals, the trader has divergence, which is a warning signal suggesting further analysis is necessary. The absolute level of the two lines should be considered in light of the normal range. Movements above this range indicates to a technician an overbought securities and are considered bearish. Movements below the range indicates an oversold securities and are considered bullish. Crossovers of the two lines can also give trading signals for some same way crossovers of two moving averages, giving signals with the percentage K moving from below the percentage D line to above it. This move is considered a bullish short-term trading signal. Conversely, with percentage K moves above of the percentage D line to below, this pattern is considered bearish. In practice, a trader can use technical analysis softwares to adjust trading rules and optimize the calculations of the stochastic oscillator for a particular security and investment purpose, e.g. short-term trading or long-term trading. The reason technicians uses historical data to test your trading rule and find the optimal parameter for each security is that each security is different. The group of market participants actively trading differs from security to security, just as each person has a different personality, so do groups of people. In effect, the groups of active market participants trading each securities are in partly their personality of the trading activity for the security. As the group changes over time, the ideal parameter for a particular security may change. Example 28 provides a great example of how the stochastic oscillator can be used together with trend analysis. The exhibit provides the weekly price charts and stochastic oscillator for Australia Boston. Moving average convergence / divergence oscillator. The moving average convergence / divergence oscillator is commonly referred to as the MACD, which is pronounced MACD. The MACD is different because a short-term and a long-term moving average of the stock price. The MACD is constructed by calculating two lines, the MACD line and the signal line. The MACD line, a difference between two exponentially smoothed moving averages, generally 12 to 26 days. Signal lines, exponentially smooth average of MACD line, generally 9 days. The indicator oscillates around 0. There's no upper limit rather than a set of overbought oversold ranges for MACD. The analyst compares the current levels of the historical performance with the oscillator for a particular security to determine what a security is out of its normal sentiment range. The MACD is used in technical analysis in 3 ways. The first is to note crossovers of MACD line and the signal line. As discussed from moving averages, the stochastic oscillator crossovers from the two lines may indicate a change in trend. The second is to look for times where the MACD is outside the normal range for a given security. The third is to use trend lines for MACD itself. When MACD is trending in the same direction as price, this pattern is convergence. And when the two are trading in opposite direction, the pattern is divergence. Exhibit 29 shows a daily price chart of ExxonMobil at the top with MACD oscillator for March through October of 2005. Note the convergence of the bottoming of the So we have the MACD line and the signal line. Sentiment indicators. Let me go get water really fast. I'll be right back. Okay, sentiment indicators attempt to gauge investors' activities for signs of increasing bullish or bearish. Sentiment indicates comes in 2 forms: investor pools and calculated statistical indexes. Opinion pools, a wide range of services conduct periodic polls of either individual investors or investor professionals to gauge their sentiment about the equity market. The most common of these polls is the investor intelligence advisor sentiment report, market vein bullish consensus and consensus bullish sentiment index, and the daily sentiment index, all of which are polls are pool investment professionals, and reports of the American Association of the Individual and the Individual Investor, or the AAII, which pools individual investors. All but the AAII are subscription-based services. Borons Magazine publishes data from 4 of these surveys on a weekly basis. By regularly compiling these data over time, the presentation of and presenting it graphically. These services provide technicians with an analyzable snapshot of investor sentiment over time. Technicians look at prior market activities and compares it with highs or lows in sentiment, as well as inflection points in sentiment as a gauge when they are forecasting the future direction of the market. The most widely used investor pool are all US based. One reason for the interpretation of the survey is determined by comparing the survey results with market performance over time. To gauge a survey's usefulness in predicting major market turns, the survey must have been published over several cycles, and each of the surveys mentioned here based on US data has been available for several decades. 3.4.3.2 calculating statistical indexes. The other category of sentiment indicators are indicators that are calculated for market data, such as security prices. The two most commonly used are derived from the options market. They are the put/call ratio and volatility index. Additionally, many analysts look at margin debt and short interest. The put/call ratio is the volume of put options traded divided by the volume of call options traded for a particular financial instrument. Investors who buy put options on a security are presumably bearish, and investors who buy a call option are presumably bullish. The volume in call options is greater than the volume traded in puts options over time, so in put/call ratios is normally below 1. The ratio is considered to be a contrary indicator, meaning that higher values are considered bearish and a lower value is considered bullish. But its usefulness as a contrary indicator is limited, except at extreme lows or high levels in relation to the historical trading level of a put/call ratio for the particular financial instruments. The acting value of the put/call ratio and its normal range differs from each security or market, so no standard definition of overbought or oversold levels exists. At extremely lows where call options volumes is significantly greater than put option volumes, market sentiment is said to be overly positive that a correction is likely. At extreme highs in the put/call ratio, market sentiment is said to be extremely negative and an increase in price is likely. VBOE, Volatility Index, or VIX, is a measure of the near-term market volatility calculated by the Chicago Board Options Exchange. Since 2003, has been calculating from option prices on the stocks of the S&P 500. The VIX raises when the market participants becomes fearful and an impending market decline. These participants then bid up the price of puts, and the results of an increase in the VIX lead level. Technicians use the VIX in conjunction with trend patterns or oscillator tools, and it is interpreted from a contrarian perspective, where other indicators suggest that the market is oversold, and the VIX is the VIX is extreme high, and the combination of the considered bullish. Exhibit 30 shows the VIX from March 2005 to December 2009. Margin debt is also often used as an indication of sentiment. As a group, investors have a history of buying near market tops and selling at the bottom when the market is raising and indexes reach new highs. Investors are motivated to buy more equities in the hope of participating in market rally. A margin account permits an investor to borrow parts of the investment cost for the brokerage from the brokerage firm. The debt magnifies the gains or loss resulting from the investment. Investor psychology plays an important role in the intuition behind the margin debt. As an indicator, when stock margin debt is increasing, investors are aggressively buying and stock prices will move higher because the increased demand. Eventually, the margin traders use all their available credit, so their buying power, and therefore demand decreases, which fuels a price decline. Falling prices may trigger margin costs and force sellings, thereby driving prices even lower. Brokerage firms must report activity in their customers' margin account, so keeping track of borrowing behavior is relatively easy. Example 31 provides a 10-year comparison of margin debt and the S&P 500, and the correlation is striking. Rising margin debt is generally associated with rising index levels. A falling margin debt is associated with a falling index level. In fact, for the 113 months as shown in Exhibit 31, the correlation coefficient of the margin of the S&P is 80.2%. When marginal debt peaked in summer of 2010 or 2007, the market also topped out. Marginal debt dropped sharply during the later part of 2008 as the subprime crisis took the market down. Investors began to borrow funds against the first half of 2009 when heavily discounted shares began. So we could see the correlation between the margin debt and the U.S. market, and we could see how they are greatly correlated, and highs are likewise also related to highs. Short interest is another commonly used sentiment indicator. Investors sell shares shortly when they believe the share price will decline. Brokerage firms must report short sell activities, and these statistics are aggregated and reported by the exchange and financial press on a monthly basis. The number of shares of a particular securities that are currently sold short is called a short interest. The short interest ratio represents the number of days of trading activity represented by short interest. To facilitate comparisons of large and small companies, common practice is to normalize this value by dividing short interest by average daily trading volume to get the short interest ratio. Short interest ratio equals short interest divided by average daily trading volume. Example 3. Short interest ratio. At the end of September, 9 barons reported short interest of this much shares in Goldman Sachs, with average trading volume of this much. At the same time, the short interest of TB Bank was this much, or the average trading volume of this much shares. Calculate the short interest ratio for both firms. The short interest ratio for Goldman Sachs was this much divided by this much, or 1.2 days. For TB Bank, the short interest was this much divided by this much, or 17.25 days. There are differences in opinions about how to interpret short interest, and as an indicator, it is considered to show market sentiment and to be a contrarian indicator. Some people believe that a large number of shares are sold short, and the short interest ratio is high. The market should expect a falling price for the shares because of so much negative sentiment about them. A counter argument is that although the short seller is bearish on the securities, the effect of the short sales is already felt. If the in the security price, the short sellers next action will be to buy shares back to cover their short positions. When the short sellers cover their positions, these actions will provide a boost for the short share price. Therefore, the short interest ratio constitutes future and unknown demand for the shares. Regardless of the analyst's perspective, in example 3, the TB Bank short interest ratio is approximately 17, is more noteworthy than a much lower figure of Goldman Sachs's. 3.4.4 flow of fund indicators. Technicians look at fund flows as a way to gauge the potential supply and demand for equities. Demand can come in the form of margin borrowing against current holdings or cash holdings by mutual funds and other groups that are normally large holders of equity, such as insurance companies and pension funds. The more cash these groups hold, the more bearish is the indication for equities. One caveat is looking at potential source of demand is that although these data indicates the potential buying power of various large investor groups, the data says nothing about the likelihood that power of various large investor groups. The data says nothing about the likelihood that the group will buy. On the supply side, technicians look at new or secondary issuance or of supply because these activities put more securities into the market and increases supply. 3.4 per 1 ARMS index, a common flow of a fund indicator of the ARMS index, also called the TRIN, short for short-term trading index. This indicator is applied to a broad market such as the S&P 500, measures the relative extent to which money is moving into or out of raising and declining stocks. The index is a ratio of two ratios, the ARM index or the TRIN index. The short-term trading index is the number of advancing issues plus the number of declining issues divided by the volume of advancing issues plus the volume of declining issues. When the index is near 1.0, the market is in balance. That is, as much money is moving into rising stocks as into declining stocks. As a volume above 1 means that there are more volume declining stocks. A volume below 1, above 1 is having declining stocks. A volume above 1 means the trader is having rising stocks. Exhibit 32 shows the ARMS index for the S&P 500 on a daily basis for the first 6 months of 2009. The majority of the points lied above the 1.0 index, suggests that the market continued to be in a selling mood. Note that the up spike are associated with large price decreases in the index level, and the down spike reflects the opposite. The trend line shows a slightly negative slope, providing some slight encouragement for the bulls. Okay. The trend indicator, Sarah Johnson, CFA, recently installed some investment software and is verifying the calculation of some of the statistics it produces. Her screen indicates a trend value of 1.02 from the new app. This is not really important. Okay. Margin debt. The previous section discusses the use of margin debt as an indicator of market sentiment. Margin debt is also widely used as a flow of funds indicator because marginal loans or margin loans may increase the purchases of stock, and declining margin balances may force the selling of stocks. 3.4 mutual fund cash positions. Mutual funds hold a substantial portion of all investable assets. Some analysts use the percentage of mutual fund assets held in cash as a predictor of market direction. It is called the mutual fund cash position indicator. Mutual funds must hold some of their assets in cash in order to pay bills and send resumption checks to account holders. Cash arrives on a daily basis from customer deposits, interest earned, and dividend received. Cash also increases after a fund manager sells a position and holds the fund before reinvesting them. During a bull market, the manager wants to buy shares as quickly as possible to avoid having a cash drag hurting the fund's performance. If prices are trending lower, however, the manager may hold fund funds and cash to improve the fund's performance. Exhibit 33 shows year-end mutual fund cash in the United States as a percentage of asset from 1984 through 2008. Over this period, the average cash percentage was 6.8%. The analyst's initial intuition might be that when cash is relatively low, fund managers are bullish and anticipate rising prices. But when the fund managers are bearish, they conserve cash to wait for lower prices. Advocates of this technical indicator argue exactly the opposite. When the mutual fund cash position is low, fund managers have already bought, and the effects of their purchases are already reflected in the security prices. When the cash position is high, however, the money represents buying power that will move prices higher. When the money is used to add positions to the portfolio, the mutual fund cash position is another example of the contrary indicator. Some analysts modify the value of the cash percentage to account for differences in the level of interest rates. Cash is not sitting in desk drawers in a non-deposit somewhere earning interest. When interest rates are low, holding cash can be substantial drag on the fund's performance. If the broad market advances, when the interest rates are high, holding cash is less costly. 3.4.4.4, a new equity issuance. When a company's owners decide to take a company public and offer shares for sale, the owners want to put those shares on the market at a time when investors are eager to buy. That is, the owners want to offer the shares when they can sell them at a premium price. Premium prices occur near market tops. The new equity issuance indicator suggests that as the number of initial public offerings or IPO increases, the upward price trends may be about to turn down. A supply and demand effect is also at work, putting more shares on the market. Issuance increases the aggregate supply of shares available for investors to purchase. The investment community has a finite quantity of cash to spend. So an increase in IPOs may be viewed as a bearish factor. 3.4.4.5, secondary offerings. Technicians also monitor secondary offerings to gauge potential changes in the supply of equities. Although secondary offerings do not increase the supply of shares, because existing shares are sold by insiders and general public, they do increase the supply available for trading or the float. So from the market perspective, secondary offerings of shares have the potential to change the supply and demand equation as much as IPOs do. All right, 3.5, cycles. Over the centuries, technicians have noted reoccurring cycles of variance frequencies in the capital market. The study of cycles in the market as part of broader cycles study exists in numerous fields of study. Many observed cycles such as one in U.S. equities tied to the cycles of U.S. presidential elections has an obvious and rational justifications. Other cycles do not. However, why cycles is in fields seemingly unrelated to finance, such as astronomy or weather patterns, may influence the economy, and thus the capital markets may have a logical explanation. For example, sunspots affect weather patterns on Earth, which in turn affect agriculture. Therefore, capital markets, because they are related to agriculture. The contrative wave, the longest and widely recognized cycle, was identified by Nikolai Kondratiev in 1920s. Kondratiev was an economist in the Soviet Union who suggested that Western economies have a 54-year cycle. He He traced cycles from 1780s through the time when he publishes his theory in 1920s. And the economic depression of the 1930s, when consistent with his cycle, with the cycle he identified, his theories was mainly tied to economic cycles and commodity prices, but cycles can also be seen in the prices of equities during the time of his work. Kondratiev was executed in the Soviet purge of 1938, but his ideas have came into widespread acceptance, particularly since his work was translated into English in the 1980s to economists at the London School of Economics. E. H. Phelpsbaum and Shalia Hopkins identified 50 to 52-year economic cycle in the United Kingdom. Together with Kondratiev, credit should be given to two Dutch economists, Jacob van Gouderen and Samuel de Wolf, who wrote about 50 to 60-year economic cycles but published their work earlier. In 1913, their work came to light only recently. However, so the 54-year economic cycle is known as the Kondratiev wave or K wave. The 18-year cycle is interesting because 3 18-year cycles make up the longer 54-year Kondratiev wave. The 18-year cycle is most often mentioned in connection with real estate prices, but it can also be founded in equities and other markets. 3.5.3, the decennial pattern. The decennial pattern is the average stock market return based on the DJIA, broken down on the basis of the last digits of the year. Years ending in O's or zeros have had the worst performance, and years ending with fives has been by far the best. The DIJA was up every year, ending in 5. From 1885 until 1995, but declined 0.6% in 2005. Presidential cycle. The cycle of the United States connects to the performance of the DJIA. With presidential elections and this theory, years are grouped into categories on the basis of whether they were elected years or are the first, second, or third year following the election. The third year is the year prior to the next election. The third year shows the best performance. In fact, the DJIA expected a positive return for every pre-election year from 1943 through 2007. One explanation for this outcome is that when so many politicians up for re-elections, they inject stimulus into the economy in an attempt to improve their chances to be re-elected. Election years are also usually positive years for the stock market, but with less consistency. Post-election years are so-called midterm years, have the worst performances. The long cycles are important to keep in mind when using other technical analysis tools. However, the long cycle describes here and other theories about the long cycle present a number of problems. The primary problem is the small sample size. Only 56 presidential elections have been held in the United States, and only 4 completed Kondratiev cycles have been occurred in U.S. history. Another problem is that even with a small number of cycles, the data do not always fit in the cycle theory, and when they do, the fit may not be obvious. Elliott wave theory. In a theory proposed by R.N. Elliott in 1938, the market moves in regular repeated waves or cycles. He identifies and categorized these waves and wrote in detail about aspects of market cycles. Elliott was an accountant by training, but in 1929, after he contracted a progressive intestinal illness at age 55 while working at Latin America, he was forced to retire, and then he returned his attention to the detailed study of equity prices in the United States. A decade later, in 1938, he published his findings in a book, The Wave Principle. In developing the concept of the market moves in waves, Elliot retailed heavily on the Charles Dawes' early work. Elliot described how the market moved in a pattern of 5 waves, moving up in the bull market and following a pattern 1 equals up, 2 equals down, 3 equals up, 4 equals down, 5 equals up, and hence the wave of impulse wave. The impulse wave was followed by a corrective wave with 3 correspondents: A equals down, B equals up, C equals down. When the market is a bear market, as defined in Dow theory, that is, with both of Dow's major indices in bear markets, the downward movement are impulse waves, and are broken into 5 waves, with upward corrections broken into 3 sub-waves. Elliot also noted that each wave could be broken down into smaller and smaller subwaves. Lamau. The longest of the waves is called the Grand Supercycle and takes place over centuries. Elliot traced grand supercycles back to the founding of the United States, and his successors have continued his work. Each grand supercycle can be broken down into subcycles until ending with the submunit, which unfolds over several minutes. The major cycles are grand supercycle, cycle, primary, intermediate, minor, minute, and super minute. As an important aspect of Elliot's work is that the discoverers make waves follow patterns that are ratios of the numbers of the Fibonacci sequence. Leonardo Fibonacci was an 11th century Italian mathematician who explained the sequence in his book Liber Abaci. But the sequence was known to mathematicians as far back as 200 BCE. India, the Fibonacci sequence starts with the numbers 0, 1, 1, and of each subsequent number in the sequence is the sum of the 2 preceding numbers. Elliot was more interested in the ratio of the number of the sequence because he found that the ratio of the size of the subsequent wave was generally a Fibonacci ratio. The ratio of one Fibonacci number to the next that Elliot considered most important are the following. He also noticed that the ratio of Fibonacci sequence numbers to its preceding number is important. The ratio converge around 1.618 in mathematicians. 1.698 is called the golden ratio, and it could be found by throughout nature, in astronomy, biology, botany, and many other fields. It is also widely used in art and architecture. The ancient Egyptians built the pyramids on the basis of this ratio, and the ancient Greeks used it widely. As noted, Elliot numbered the impulse waves 0 to 5. And the collective wave A, B, and C exhibit 34 depicts the impulse and collective wave of the bull market. So the wave 1, 2, 3, and 1 increase, 2 decrease, 3 increase, 4 increase, 5 increase, peaks. A decrease, 2 decrease, so the letters A, B, C is after the peak of the numerical figures. Okay. Elliot describes the characteristic of each wave, noting the following as shown in Exhibit 34. Wave 1 starts at the basing pattern and displays an increase in price, volume, and breadth. Wave 1 consists of 5 smaller waves. Wave 2 moves down, retracting much of the gain in wave 1, but not all of it. A common percentage retracements of Fibonacci ratios, such as the 50% or 62%. Wave 2 never erases all the gains from wave 1. Wave 1 consists of 3 smaller waves. Wave 3 moves above the high of the first waves and has a strong breadth, volume, and price movement. Most of the price movement in the uptrend typically occurs in wave 3. Wave 3 consists of 5 smaller waves. Wave 3 often moves prices 1.618 times higher than the lower wave of wave 1, which is the Fibonacci ratio. A wave 4 is again a correlation of the ratio of the change in price during the wave of the price change during the third wave is generally a Fibonacci ratio. Wave A is a down wave in a bull market. Wave A itself breaks down into 3 waves. Wave B is an upward movement and breaks down into 5 waves. Wave B is a false rally and is often called a bull trap. It sounds like bull crap. When C is the final corrective wave in a bull market, it does not move below the start of the prior wave 1 pattern when C comes back down to 3 subwaves. This description of wave applied to bull markets. In bull markets, the impulse wave are labeled A through E, and the corrective waves are labeled 1 and 2 and 3. Waves in the indication of the trend consists of 5 subways, and counter waves consist of 3 subways. In practice, a good deal of time is required to become proficient with Elliott wave theory. Wave count may not be evident at first, and Elliottians often have to renumber their wave counts on the basis of changes in market trends. This theory is widely used, however, the patterns Elliott describes can still be observed today. Draw lines representing Fibonacci ratios on the chart. These lines alert technicians to the level at which trends may change in the future and can be used in conjunction with other technical tools for forecasting. Positive price movements generally take Okay. Intermarket analysis. Intermarket analysis is a field within technical analysis that combines analysis of major categories of securities, namely equities, bonds, currencies, and commodities, to identify market trends and possible inflections and trend. Intermarket analysis also looks at industry subsectors, such as 9 sectors of the S&P 500 is divided into the relationship among the major stock market and countries with the largest economies, such as New York, London, and Tokyo stock exchanges. Intermediate analysis relies heavily on the field of economic analysis for its theoretical underpinning. The field was pioneered by John Murphy in his 1991 book, Intermediate Technical Analysis. Murphy noted that all markets are interrelated, and that these relationships are strengthening with globalization and the world economy. Stock prices are affected by bond prices. High bond prices are a positive for stock prices, since that means lower interest rates. Lower interest rates benefit companies with lower borrowing costs and lead to higher equities valuations in the calculations of intrinsic value using discounted cash flows. Analysts in fundamental analysis, thus raising bond prices are a positive for stock prices, and declining bond prices are bearish indicators. Bull prices impact commodity prices. Bond prices move inversely to interest rates. Interest rates move in proportion to expectations to future prices of commodities or inflation. So declining bond prices are a signal of possible rising commodity prices. Currency impact commodity price. Bond prices impact commodity prices. Bond prices move inversely to interest rates, and I read that already. Okay. Intermarket analysis technicians often look for inflection points in the market as a warning sign to start looking for changes and trends in a relative market. To identify these intermarket relationships, a commonly used tool is relative strength analysis, which charts the price of one security divided by the price of another. Exhibit 35 shows the relative price of 10 years of Treasury bonds compared with the S&P 500. The raise in T-bar prices relative to S&P 500 can be clearly seen. An inflection point in the chart has occurred in May 2009. This point was signaled that the time has come to move investments from bonds to stocks. Exhibit 36 is a relative strength chart depicting the ratio between the S&P 500 and the commodity prices. It shows a clear top, a reversal of trend in December 2008. This inflection point shows U.S. stocks weakening relative to commodities, and would indicate that allocating funds away from U.S. stocks and into commodities might be appropriate. In addition to preceding comparisons, once an asset category has been identified, a relative strength analysis can be used to identify the strongest performing securities for a sector. For example, if commodities look promising, an investor can analyze each of the major commodities relative to a broad commodity index in order to find the slowest commodity. Okay. Observations based on intermarket analysis can also help allocate funds across national markets. Certain countries' economies are closely tied to commodities. For example, Australia, Canada, and South Africa. As economies evolve, Australia. Sure. These relationships change, so the relationships must be monitored closely. Summary technical analysis is a form of security analysis and that uses price and volume price volume market data, often graphically displayed. Technical analysis can be used for any freely traded security of the global market and is used on a wide range for financial instruments such as equities, bonds, commodities, futures, and currency futures. Technical analysis is the study of market trends or patterns and rallies on recognition of patterns that have worked in the past in an attempt to predict future security prices. Technicians believe that market trends and patterns repeat themselves and are somewhat predictable because human behavior tends to repeat itself somewhat predictably. Another tenet of technical analysis is that the market brings together the collective wisdom of multiple participants, weights it according to the size of trade they made, and allow analysts to understand the collective sentiment. Technical analysis relies on knowledge market participants putting their knowledge to work in the market and thereby influencing price and volume. Technical analysis and fundamental analysis are equally useful and valid, but they approach the market in different ways. Technical analysis focuses solely on analyzing markets and the trading of financial instruments, whereas fundamental Tao analysis is a much wider ranging field encompassing financial and economic analysis as well as analysis of social and political trends. Technical analysis relies primarily on information gathered from market participants that is expressed through the interactions of price and volume. Fundamental analysis is a much wider ranging field encompassing, Okay. The usefulness of technical analysis is diminished by any constraints on the securities being freely traded by large outside manipulations of the market and its liquid market. Charts provides information about the past price behavior and provides a basis for influences about likely future price behavior. Various types of charts can be used in studying the market: line charts, bar charts, candlestick charts, and point of figure charts. Relative strength and analysis is based on the ratio of the prices with a security to a benchmark and is used to compare the performance of the one asset with the performance of another asset. Most technicians consider volume information to be very important and watch for the confirmation of volume of a price trend or a divergence in volume from a price trend. The concept of trend is perhaps the most important aspect of technical analysis. The uptrend is defined as a security market higher highs and lower lows. To draw an uptrend line, the technician draws a line connecting the lows of the price charts. A downtrend is defined as a security making a lower hand than CJ. Support is defined as low price range in which the price stops declining because of buying activities. It is the opposite of resistance, which is price range in which price stops rising because of selling activities. Chart patterns are formation appearing in price charts that create some type of recognizable shape. Reversal patterns signal the end of a trend. Common reversal patterns are the hand and shoulders, the inverse hand and shoulders, double tap and bottom, and triple top and bottoms. Continuation patterns indicates that the market trend in place prior to the pattern formation will continue once the pattern is completed. Common combinations patterns are triangles, rectangles, flags, and pennants. Price-based indicators incorporate information contained in market prices. Common price-based indicators are moving averages and Bollinger Bands. Momentum oscillators indicators are constructed from price data but are calculated so that they fluctuate either between a high and low, typically 0 and 100 or around 0 or 100. Some examples are momentum or rate of change oscillators and RSI. Stomach his measure of MACD. Okay. Sentiment. Okay, I read that already. Sentiment indicator attempts to gauge investors' activity by signaling increasing bullish or bearish. Sentiment indicators come from two sources: investor pools and calculated statistical indexes. Option pools to gauge investor sentiment towards the equity market are considered by a variety of services. Commonly used as calculated statistical indexes are the pool/calculator. You literally have it on fund indicators help technicians gauge potential changes in supply and demand for securities. Some commonly used indicators are the ARMS index, also called the trend marginal debt,
Also a sentiment indicator, mutual fund cash positions, new equity, insurance, and secondary equity offerings. Many technicians use various observed cycles to predict future movements in security prices. These cycles include Kandrov wave, the decimal pattern, the decimal pattern, the U.S. presidential cycle. The Elliott wave theory is an approach to market forecasting that assumes that markets are repetitive wave patterns, which are themselves composed of smaller and smaller subwaves. The relationship among the wave heights and frequency is the Fibonacci ratio. Intermarket analysis is based on the principles that all markets are interrelated and influence each other. This approach involves the war with approaches investors to use the relative strength analysis of different groups of securities, e.g. stocks versus bonds, sectors in an economy, and securities from the different countries. Okay, we finished quantitative analysis. Okay, so good. I am so happy. And then next we have an index, and then we have some terminology. Following the finish of a fund of technical analysis, we have quite a lot of terminology, and then we have our index. Okay, and our next section is economics, one of my favorite sections. I also study economics, so it should be quite fun and quite easy for me. So in our next reading, we're going to be starting economics, and it's going to be really fun for everybody involved. So without further ado, I want to thank you guys all for tuning in again, and I hope to see you guys in the next reading for economics. Goodbye.